everyone. My name is Brett Mooney, and welcome back to Mooney Talks Money. I wanted to spend some time today shedding some light on two major indexes a lot of people are keeping their eyes on or like to track when putting together their own investment portfolios. And I wanted to give you guys some ideas on how you might want to consider allocating things moving forward, given the kind of upswing in markets that we've seen so far in 2023. The first thing I wanted to do with you guys today is share my screen with you and give you an idea of the sector performance we've seen in the S&P 500, because we have seen a nice year-to-date return in the S&P, but I wanted to point out that it's been a pretty concentrated return, right? And as you can see here, you can see the top three sectors in the market. The largest being information tech. That's had a 42% return year-to-date in the market, or in that sector as a whole so far this year in 2023. The other sectors we've seen some really positive performance in is consumer discretionary and then communication services as well. As you can see, the other 6 or 7 indexes or sectors within the S&P 500, we haven't seen double-digit returns outside of industrials. Looks like has had a good couple of weeks here and is in the double digits now. But spaces like financial services, healthcare, energy, and utilities all have negative year-to-date returns so far this year, right? So we haven't really seen a full broad-based market recovery. We've really seen kind of a tech-based or an AI-based kind of market recovery here thus far in 2023, which will bring me into the bulk of what I wanted to talk about today, and that is the S&P 500 and the NASDAQ or the QQQ index. So I'm going to go ahead and pull up the S&P 500 just to give you an idea of what it looks like to invest in that index right now. And as many of you may be aware, the S&P 500 is actually a cap-weighted index, meaning the size of the company matters in terms of how much of your portfolio's assets are invested in those companies. And you can see in the S&P, the top 10 names actually make up about 30% of the total assets of the S&P 500, right? So if you invested in the S&P 500 today, roughly about 7.7% of your portfolio will be in Apple, and so on and so forth on the way down, right? So you'll notice that if you invest in the S&P 500, about 30% of that money is going to be pretty concentrated in 10 major names within our markets, right? Now, the other thing I wanted to point out is the performance we've seen so far this year, right? The S&P is up in the 16% range as of earlier or as of late last week. And what I wanted to point out is we've seen most of that return in those top 10 names of the market, right? And what I wanted to show you here is just a breakdown of the RSP portfolio, which is the S&P 500, but it's equally weighted across all 500 companies, as opposed to having about 30% of the portfolio in those top 10 names, right? And as you can see, right, that diversifies your portfolio pretty substantially here, right? And year to date, this may not have been a better strategy than being in the cap weighted index, but given kind of the run up we've seen in certain sectors of the economy, now could be a good time for you to diversify that portfolio a little bit and get some investments into some smaller names in the market, right? So you can see how much more diversified the top 10, even top 100 names are in the S&P 500 or in that RSP or equal weighted type strategy. So it could be a good idea to take some of the risk off the table on some of those bigger names, right, and to allocate it across some of those smaller companies across the market. The other thing I wanted to illustrate on that front is just the S&P and the RSP, which is the equal weighted S&P over the last 5 years, right? And just give you a little bit of a technical analysis on the two. And you can kind of see how the RSP and S&P have traded over the last 5 years. And you can see so far this year, there's actually a pretty big spread, right? There's about a 17% spread between the cap weighted and the equal weighted indexes, right? And over time, you can see that spread is about as high as it's ever been across those two indexes, right? Meaning that from a technical analysis standpoint, it might make sense to start to increase some of those equal weights or those smaller companies into the portfolio, right? Because there may be some outperformance there given the run up we've seen in some of those bigger companies. So that's the S&P 500 index versus the RSP, right? It's a cap-weighted index versus a equal-weighted index, right? And it's a way to reduce exposure to those top names and get you some more diversified exposure across the S&P 500. It's a very similar story on the QQQ index, right? If a lot of you may be aware of the NASDAQ or QQQ, and QQQ is the top 100 tech stocks in the market, or top 100 tech stocks not including financials. And you can see the top 10 holdings in QQQ are pretty substantial as well, right? So if you invest in the QQQ index, essentially about 50% of your portfolio, right, across these 10 names is going to be invested there, right? So if you put it in the QQQ index, right, the 50% of your portfolio is going to be allocated to the top 10 names here in that index, because again, it's a cap weighted index. And as you can see, there are equal weighted options with the QQQ index, just like the S&P, right? So if I break down those holdings, as opposed to having 50% or so in those top 10 tech names, right, you really break down that index and you evenly invest across all of them, right? So as opposed to having 30% in 10 names, right, you have a 1% in 100 names diversified across the whole tech space, reducing some of the exposure to those top names there as well. I did a breakdown of QQQ versus QQEW, which is the equal weighted versus cap weighted index, right? And you can see kind of the difference in those portfolios or in those indexes over the short term here, right? Like over the last 5 years, right? The biggest spread we've seen in those two indexes was back in 2021, right? Those were previous highs for the S&P, QQQ, and most stocks back in 2021, right? And there was a pretty big spread there, right? And at that point, from 2021 to about middle of this year, right, had actually outperformed the equal weighted index. It actually outperformed the cap weighted index from the highs in 2021, right? And you can see the spreads here are starting to get pretty wide again from a technical analysis standpoint, right? So I've had a lot of clients ask me like, Brett, hey, I have some money that I'd like to put to work, but I don't really want to get into the tech space or some of these spaces that have huge exposures to certain companies. Well, this could be a good option for you to get into that space and to diversify it across some smaller companies or more companies, as opposed to just the top 10 or 15 names in those indexes. The other way is some clients want to get more aggressive, right? Hey, Brett, I see that long-term, the top 10 names tend to outperform markets, right? And there are options for those things as well. But granted, those top 10 names have done really well this year, right? So from a fundamental perspective, right, it doesn't really make a whole lot of sense to put a bunch of money in 10 names, and it might make a little more of a better long-term game plan to diversify that across a lot of different names, as opposed to those top 10 names in those two indexes. That's what I had for today with Mooney Talks Money. Feel free to leave a comment below or a comment below with some topics that you'd like me to address here in the future. I appreciate you guys checking in with me today. Thanks.